Hello, everybody, and thank you for joining us for this week, Monday, July 13th, 2020. I'm Jay Gragnani. Here joining me this week is Steve Raymond, and hope everybody is having a great summer. The month of July, hard to believe it is almost halfway in the books now. As the second quarter of the market is certainly in full swing. And as we're recording this on Monday, the market is Dow up over 400 points. We continue to see positive signs out of a number of equity indexes, but really across the board today, all sectors are in the green, being led today primarily by healthcare, some of the news out of potential drug treatments coming out today, but healthcare being the best performing sector as it stands today, as the market is being open right at 1 o'clock. Consumer discretionary also right there doing well, but a number of sectors up over 1% today on some positive news out. And so what we wanted to do this week is number one, provide a little bit of recap in terms of performance over the past week, performance so far in the third quarter of the year. As well as look at some further positive developments that we've seen coming out of individual charts, specifically the point and figure chart of the S&P 500 breaks out to another positive sign there. Also, while the international equities have seen some notable improvement, international equities have flown under the radar a bit here recently, but seeing some very positive improvement brewing under there. And then energy is a sector that had seen some very strong performance off the bottom, saw energy move back into positive trends in many cases from a number of individual stocks, but we've seen some weakness and deterioration there within the energy sector that we did want to mention and touch on. And so, as we look today, getting into it, the S&P 500, Steve, on the 20-point chart that we're looking at here, actually gives another buy signal at 3,200, completes a bullish catapult pattern. And as it was able to hold that support from earlier back in June in the 2980 to 3000 level, but certainly look set now at that 3220 area as your next area of resistance on the S&P 500 chart, which you're basically bumping right around close to that today as we're looking at this 3225 is where the S&P 500 is right now.
Yeah, you're basically back at a similar point of testing after some 20 market days, and I think this breakout, for all intents and purposes, with the relative strength, gaining in some of the equity sectors and so forth, it's virtually highly likely to see that breakout. Now, this also raises your what we might call a trailing alert, to the 3100 level. If we saw the market sell off past the 3100 level to the south side, that would be an alert that might be some short-term weakness. And then the 3000 level is prior support levels, that we can, we have pointed out before, and you kind of want to keep up with those as we keep migrating, towards the right or, through time, is knowing where your trailing alerts would be, and those support levels that can certainly help you with intra-period or onboarding or other types of, risk management with the portfolio. And it's certainly, to reiterate, as you're bringing new clients on, you want to know where those support alerts would be. But things look good, as the S&P is, again, putting in some new buy signals here and likely to, continue to venture north is the high suspicion. Back to you, JG.
Yeah, and you look, even just over the past couple of weeks, and since we've kind of moved into the month of July, a lot of the themes, a lot of the trends that have been persistent this year are certainly still intact. And you see amongst the sector ETFs, communication services, right up there in terms of performance. So far this month, in the month of July, up 6.7%. The NASDAQ 100 up 6.6%. And the NASDAQ 100 year to date is up over 24%, primarily being led by technology and the communication sectors there. And it's really been that story on the NASDAQ 100 side really continues to be the story of just large cap technology, large cap growth stocks in general, really carrying this market. As you look, prior to today, the S&P 500 down about 1.4% on a year-to-date basis. But that is very much skewed towards those larger cap names doing well. And you look at the difference between, -1 on the S&P and -11 on the S&P equal weighted. And that really kind of tells the story of what we've seen this year in terms of the leadership trends, the large caps, the growth areas of the market just continuing to really carry this market. Small cap index, IWM, the iShares Russell 2000, down about 1% so far this month, a little over 1%, and down almost 15% on the year. And energy so far over the past couple of weeks has been the worst performing sector. As a matter of fact, only one of two sectors that is actually down prior to today's action, but down in the month of July, industrials being the other. But we continue to see strong returns out of those leadership areas of the market. And one which was very interesting, you look at the top of the list there, and emerging markets, EEM, up over 8% so far this month, in the month of July. And we'll touch a little bit more on the international markets here in a minute, but EFA as well. So that's going to be your big developed ex-US countries, sitting right there just behind the S&P 500 over the course of the past couple of weeks, up 2.4%. So, certainly interesting developments that from a performance standpoint that we're watching. And when we go and we look at, a bigger picture, looking at the asset class group scores page, we've begun to see, Steve, some positive movement on the score standpoint out of some of the international groups, as well as continued strength out of some of the U.S. groups.
Yeah, this is an important time frame. Often we say this is, kind of that first seasonal period of weakness. But let me point out that, over historical time, there are many years where the summer can do quite well with equity, and here you got a position where a lot of major asset blocks, both U.S. and non-U.S., are scoring above 3. So that's very important news. And I think new developments that allow more asset classes that are very important to a general asset allocation to say, hey, there's some favorability widening out across the board. Let me point out that some weeks ago we mentioned that the core percentile rank of the S&P core, had dropped a little bit into the 70s, and the money market percentile rank, which gauges kind of risk in the market, it popped up into the mid-30s, and that was kind of a queasy moment there. I will point out since we crossed into July, the core percentile rank moved back up into what I call a kind of a comfortable dominant position in the 85% level, and money market is abated back down to a 23% reading today, back down into that bottom quartile. So it's kind of a favorable mix for asset allocation thought, where equities are presenting some good opportunities. Certain types of fixed income are certainly presenting good opportunities, and cash is presenting a less of a obviously an opportunity, as cash is only stronger than 20% of the asset classes around the world at this juncture. Let me point out, this is a macro asset class view, and you can see the blue groups. There's a couple of them, the municipal bonds and the core of the S&P 500 market. We have other views as well. The major views and other views, some views that we're not showing today, but I will point out there are other blue groups amongst the S&P 500 core. I'll name some notable mentions leading the way, which would be internet and technology, convertible bonds, and healthcare, as well as large cap growth, mid cap growth, and a newcomer over the last month, I think, is small cap growth. So you kind of a sweeping set of growth groups with convertible bonds, with some other sectors, including precious metals, that are also scoring above the score 4. So there is a presentation of some broad choices to diversify an allocation with, and that's good news. With this context of how the macro asset classes are coming around. Real estate, let's say, is on the bottom of the macro asset class view. We don't see the action there at this point, but I do think that you have an innumerable amount of groups that are doing well, and funds from those groups where you can complete a full asset allocation, feeling like you have some breadth and some width and some diversity in doing so. So I think that July shows, that we're, I think, doing well. and as we'll mention maybe over the next few minutes, non-U.S. is kicking in to help with this breadth and diversity, which is very good news. I'll hand that back to you, JG, and maybe we can explore that further.
Yeah, and you mentioned, some of the international groups certainly scoring well, and in particular, it's really been led by emerging markets. And you look at, a couple of ETFs, the iShare MSCI Emerging Market ETF, EEM, Invesco DWA Emerging Market Momentum ETF, PIE. Both of those returned to positive trends in the case of EEM in early June. In the case of PIE, it did so at the end of May. And we've continued to see those move higher in absolute price, close in on those January peak levels. The PIE is very, very close to matching that January 2020 level, up at $20. But there's a lot of strength out of emerging markets in general. Whether it's these two ETFs or some individual countries. If you look underneath, China certainly the most important country in terms of its exposure in broad-based emerging market indexes like EEM, but it is also the most important country as well inside of PIE. PIE has the ability to adapt over time with the quarterly rebalance reconstitution process, and that just happened at the end of June, where it rebalanced its index construction methodology. And China is the largest country weight inside of PIE now at about almost 40%, about 39% of the holdings inside of PIE are Chinese companies. Another 30% of those are Taiwan. And then you have some Thailand, Malaysia in there as well. So, certainly on the non-US side, when you look at the strength, emerging versus developed, certainly the emerging market space has come along quite a bit, and has done so, with scores on both PIE and EEM having jumped notably here over just the course of the past week. EEM score has jumped quite a bit, and that's Steve. When you look at a different view on the asset class group scores page, we looked at macro, and you touched on a couple of the other. We can pinpoint even just the non-U.S. groups, and we continue to see a number of positive groups, but China sitting right there at the top.
Yes, JJ, this is kind of a phenomenon as China heats up to technically hit the score of 5 and beat a score of 5, which is, again, a notable sign of strength. I think in reviewing different ETFs and so forth from supposed China exposure, you got to say it's really broad. They're all kicking in, if you will, on this bullishness. I want to make another point as well, which would be the emerging market type groups. Now, if you look at the emerging market type groups that are enumerated about 10 slots down from the top of this view, emerging markets and emerging markets diversified, they're similar groups that basically what they handle is all diversified emerging market type funds, which are mandated to have diversity in how many different markets they're in, as well as individual country funds, which we also could call emerging markets. And then they're measured, as we find them, some China, some this, some South Korea, some that. And what we find is those scores are generally striking around the 360 level. Now, take note, in the heat of the sell-off, as we made it into some March lows, these same groups were scoring at 1.50 points, a 150 we call it in vernacular, which is a terribly beat up score in those days. And what we've got here are these scores have basically come up to the level of 3 and got up to the level of 360. Another way to say that is emerging markets has moved up 2 full points in a very, I would say, reasonable amount of time, 40 days or 60 days, some of those nature, where you have a major move of 2 full score points, which I think catches a lot of attention. Keep in mind that one of those 2 points is July by itself. So from July 1st to now, where we're basically a working week or so into the month, is 1 full score point on all the emerging market funds, no matter how you dice them up. So I think that's a good punch up to do several things. One, get scores above 3, but more importantly, getting scores above 350 on average, which is a great score level to kind of say that's a good solid citizen there. And we don't know if this is stopping. So, I mean, what we may need to monitor for, and what you want to be encouraged to monitor for, is maybe the scores get to, 4 and higher on average. But certainly, I think the point that they're up 2 full points from the low, I think, catches attention, and again, gives you more breadth to the asset allocation choices that you make now, as you move in, to broaden out the so-called only some blue chip stocks from America are leading the market. As you can see, there's a lot more action than just that. As we mentioned, mid-cap growth, small-cap growth, convertible bonds, now non-U.S., emerging markets. And that's before we even get down into single country funds. So, I think this is good news and certainly a notable move by the emerging market clan to help substantiate that there's things going on inside the U.S. which is an old story, and now you can say that there are things going on outside the U.S., which is a broadening story. And I think it helps bolster this bullishness of saying, hey, there's equity positions to take. There's equity positions that are not just banked on just one large cap pillar stock. There's a lot more going on in the market, and July reveals that this is true. So, these are some pretty bullish developments from the emerging markets. And of course, that could drill down into international small cap and other things. But the rule of thumb is, go with the basic big building blocks that you see first. As you have extra money that you want to work with, more what I would call higher relative risk groups, you may do so. But I think the standard EEM or the PIE, which is a Dorsey Wright product, are excellent choices to say, hey, I'm taking exposure to the non-U.S. via emerging markets, and those scores are picking up and getting towards leadership and extremely respectable in the score range. Back to you, JG.
Yeah, and international for the past, a number of years now. I mean, it probably 10 years now. It has been an asset class that has generally underperformed U.S. markets by and large. There's been a lot of volatility in the international space, but you go, a decade before that, so you go back to the 2000 and 2010 time period, and international equities were very, very strong and actually in most markets outperform that of the U.S. So, it's interesting here to see, not that international has overtaken U.S. from an asset class leadership perspective, but, we know that international equities certainly can perform well, can have good sustainable leadership trends within there. And so it's interesting and probably in some ways encouraging to see some of these international equity groups that had been beaten down so hard, that had such poor scores, are coming back and getting back towards scores that are acceptable in some cases, doing very, very well in the case of China and some of the other Asia Pacific areas. On the other end of that spectrum, one of the areas of the market that we have seen obviously had been beaten up, but saw a rather notable turnaround was energy. And energy, this is just looking at XLE, which is the energy select sector spider. I mean, energy is a sector that has been volatile for a number of years now. But actually, in the case of XLE, earlier this year, back in June, saw that trend turn back to being positive for the first time in a while. Saw a number of individual stocks, Exxon and Chevron, some of the big names in the space, saw some long-term relative strength, positive developments come out of energy. And that is seemingly going away as we're beginning to see the energy theme, the energy trend start to roll over. There's a number of pieces of the equation that are starting to line up now for energy. One in the trend perspective with XLE moving back into a negative trend. Also with Exxon and Chevron, both respectively, those two names recently moved back into negative trends as well. But you're also beginning to see that show up on a long-term relative strength perspective as well. Energy as a sector has fallen in terms of its sector ranking within Dolly. It had gotten up to number 1 coming off of the bottom. It is now backed off to number 3 as it's lost a number of sell signals and very, very close to falling out of the top half of those rankings. So that, if you've got exposure to energy, we're beginning to see some signs of rotation of energy that moved into some sector models, begin to rotate out of some of those models as well. So just to say, as is important to identify where the leadership trends in the market, if you bought energy stocks for all the right reasons, all the good turnaround signs, just make sure that the reasons for buying them are still valid. They're still true. If you've got names that are violating trend lines, just be cognizant, be aware of those names, and you might look to weed some of those positions out of the portfolio. Lastly, we kind of touched on this, but we've seen obviously markets doing well today. XLG, which is the Invesco S&P 500 top 50 ETF. So it takes the S&P 500 universe and it owns just the 50 largest companies within that index. Today, as a matter of fact, XLG got back to a new all-time high, actually exceeding the February level. And while the S&P and the Dow, most of those indexes remain, a good bit below their February lows, this kind of speaks more to that trend of large cap and growth, by and large, being the big dominant trend in the market right now. And when you drill down underneath the surface and you look at XLG on the left there versus SPY, so just the top 50 versus all 500 S&P 500 names there. Obviously, the top 10 holdings are going to be the same, but there is more weight toward those big names. So Microsoft and Apple, as an example, account for over 20% of the movement of XLG, which has gotten back to a new all-time high. Further, you drill down, look at the sector comparison in S&P 500. Technology is the largest sector in the S&P 500 at about 29%. But when you just focus in on those top 50 names, that sector weight in technology goes up to almost 43% down there. And so that's really the big difference. It's just the continued overweight towards technology. While energy, as volatile as it's been, at only a 2% weight, it just doesn't carry a ton of weight inside of the S&P 500 or inside of XLG, the mega cap portfolio. So just interesting to break down and kind of see where those charts have traded, see where the sector breakdown when you carve out just the 50 really mega cap names within there, and XLG's up about 7% this year versus S&P 500 down just over 1% again prior to today's action. So this compare tool, this is something that you have the ability on the website. If you are on a chart of an ETF, you can click on the fund comparison button and you can put the ticker symbol of any two ETFs in there, and it will give you this breakdown, the top holdings, the sector breakdowns, and all that kind of good stuff. So that's something that you can run on the website for you. If you have any questions about how to do that, please don't hesitate to give us a call. Our phone number is down there, 804-320-8511. You can also reach us via email, dwa@dorseyright.com. With any questions, comments, concerns, anything Steve Wright talked about here on the call, or any other general questions about individual stock positions or sector rankings or ETF portfolios. So with that said, Steve, appreciate you joining this week. Thank you all for taking time out of your busy day to join us and listen to our market update call. As always, we appreciate your time, value your feedback, so please let us know if there's something we can do for you. And everybody stay healthy and safe, and look forward to talking to everybody soon. Thank you.